In the meantime, joining us as we count down to the opening bell on Wall Street is David Bianco. He is Chief Investment Officer at DWS Americas. And David, I know that you think this is an incredibly difficult environment for investors. I concur. What do you tell people to do as a result?
Good morning. I'm not on TikTok. Thanks for having me. We're telling investors to really, well, look, it's still a very challenging environment because it's still a very uncertain environment. Now, we look at these tech stocks and we all wish that our entire portfolio were these tech stocks. We are overweight tech. That has helped us, but we've been underweight equities, particularly the value stocks. And frankly, I think the economy as well as the earnings results that we got during second quarter earnings suggest that you should stick with the growth stocks, wait longer, probably past the elections before buying value, financials, energy. I think many industrial capital goods are still going to be challenged through the year. So don't fight tech, own it. At the same time, keep cushioning your portfolio. We see opportunities in corporate credit, particularly the spreads, municipal bonds, and selectively in real estate. But I know that everybody wants their portfolio to do as well as these tech companies have been doing. And in many cases, it's justified. However, be aware of the risks. Keep cushioning the portfolio.
David, when you say you're underweight stocks, are you making up for it by what you mentioned with real estate and with corporate bonds, or do you have a large portion of cash that you're keeping now, too, on the sidelines?
I would say we're not keeping up with it. We've not been overweight cash. We've been overweight corporate credit. And corporate credit has done well, particularly versus value stocks, particularly on a risk-reward basis. But it's these tech stocks that we all wish we had more of, and we are overweight them. And as they get bigger, we wrestle with how large of an overweight can we justify. But the earnings results from last week and the continued challenges to this economy make us feel compelled to stick with it. The valuations are demanding, but these companies seem to deserve it.
Hey, David, I got an email from Art Cashin a little bit ago, and he points out that when it comes to Apple, they could be benefiting from a bit of a short squeeze on shares that are on loan to short sellers because people want to get ahead of this before of the stock split. Does that make sense to you?
Well, there are skeptics out there about the technology companies, particularly their valuations. However, we find that this tends to be more of a loved sector with less shorting activity than you would find at other sectors like airlines. So I don't think it's a short squeeze. Frankly, I think it's just fundamentals, strong earnings growth that has taken these stocks to where they are, these mega cap tech titans that they are. And we acknowledge the valuations are demanding, but we're not going to fight it. And we think there's an element of defensiveness, if you will, that these companies offer when the pandemic remains a real threat going into this winter.